Hey everyone, it's Justin from Number Crunch Nerds. So let's say that you want $250,000 of annual cash flow in your retirement years in order to fund your lifestyle. But you also want to be in the 12% marginal tax bracket for all of your retirement years. Now, is that even possible? Well, the Marcy family over here figured it out. Do you know what they did? They performed the Roth Conversion Wealth Flip. Okay, so in order to understand the Roth IRA conversion wealth flip strategy, let's compare the financial situations of the Marcy family, which is over here on the left, versus the Darcy family, which is over here on the right. So here is a summary of each family's financial situation as of 2026, as well as some high-level results from their personal tax planning template analysis. All right, starting here with interest income. The Marcy family for 2026 has $45,000, and the Darcy family also has $45,000. Now, with respect to pension income, Mr. Marcy has a $47,000 pension starting in 2026, and Mr. Darcy also has a $47,000 pension starting in 2026. Both Mr. Marcy and Mr. Darcy have a gross Social Security benefit of $42,000 apiece, and both Mrs. Marcy and Mrs. Darcy have a gross Social Security benefit of $35,000 each in 2026. Both families are taking the standard deduction, and all individuals are over the age of 65. So we have a $35,500 standard deduction for each family. Now, the retirement account balance as of 12/31/2025 for both Mr. Marcy and Mr. Darcy is $1.5 million. And then the retirement account balance for both Mrs. Marcy and Mrs. Darcy is $1.2 million apiece as of the end of 2025. But here's the big difference. The marginal tax rate for the years 73 through life expectancy, and we are going out to the surviving spouse being age 95 in both examples for both families. In that situation, the Marcy family has a marginal tax rate of 12% during this entire time period, while the Darcy family is facing a marginal tax bracket of 24% during the same time period. In addition, the highest IRMAA bracket that will be faced by each family between the ages of 73 through life expectancy will only be the first IRMAA bracket in all of those years for the Marcy family. However, over here with the Darcy family, they will be facing IRMAA brackets that reach up into the second, third, and even fourth IRMAA bracket during this time period right here. The final results, as shown right here in the green section, is that the excess income tax paid by the Darcy family in excess of what the Marcy family will pay over the lifetime of this example is a whopping $641,000 in income tax, plus another $66,000 in IRMAA surcharge, resulting in a grand total excess tax and IRMAA paid by the Darcy family of over $700,000, all because the Marcy family chose to employ the Roth Conversion Wealth Flip, and the Darcy family did not. So let's hop into the personal tax planning template and see how the Marcy family managed to get so far ahead of the Darcy family by performing the Roth IRA conversion wealth flip. And by the way, if you enjoy this video, please like and subscribe, and let me know in the comments how things are shaping up with your 2026 personal tax planning situation. Okay, so here we are inside of the personal tax planning template. Let's set up the fact pattern, and then we will complete the wealth flip. So starting right here, remember I said that both families have $45,000 of interest income. I think in the fact pattern I actually said that was starting in 2026, but it doesn't make any difference because both families are going to be at the same starting point. So let's just say that started in 2024, and then we are going to apply our usual 3% cost of living adjustment. So by the time we get out to 2026, it's going to be 47,741. But that is neither here nor there because we are going to be measuring the results of the wealth flip for the entire time that is included in the calculation, which if we hop over here to Input IQ, you can see we're going to run the calculation through 2052, and we are going to start testing widow's penalty in 2043. So if I scroll out here to the right, you can see that assumes that spouse 1 will pass around the age of 86, and then we're projecting surviving spouse living to the age of 94. Okay, now coming back over here to the fact pattern, we are starting the pension for spouse 1 at $47,000 right here. We are going to apply that 3% cost of living adjustment. Coming back to Input IQ and looking at the setup for Social Security, there's the $42,000 for spouse 1 and there is the $35,000 for spouse 2. It looks like I've started them at the full retirement age of 67 for each person. So actually we're looking at the $42,000 right here in 2024 for spouse 1, the $35,000 in 2025 for spouse 2, and then with our 3% cost of living adjustment, we're at $44,558 for spouse 1 in 2026 and $36,050 for spouse 2. Those numbers will, of course, carry to the Social Security and Pension Summary tab, and then in this situation, they have been determined to be 85% taxable. So we're looking at $37,874 and $30,643 as the taxable amounts in 2026. And so right here's our $37,874 and $30,643. Now coming over here to IRA entry tab number 1, you can see our starting value at the end of 2025 of $1.5 million in the traditional IRA for spouse 1. And then right over here in IRA entry 2, we are looking at the $1.2 million starting point at the end of 2025 for spouse 2. So with those values in mind, we are calculating RMDs starting at the age of 73 for spouse 1. Same thing for spouse 2 right here. Both spouses have turned the age of 73 prior to 2033. Therefore, RMDs will start at the age of 73 instead of 75. And so that is our setup for the comparison between the Marcy family and the Darcy family. Both families are going to start exactly like this. The only difference is that the Darcy family, the family that is paying over $700,000 more in income tax and IRMAA surcharge combined, they will just be sticking with this initial setup right here. In other words, they have decided to do no tax planning. They are just going to accept the results as laid out in the initial fact pattern. And so this first personal tax planning template example right here, what I have called wealth flip number 1, the initial setup, this will represent the Darcy family, the family that is overpaying. The only difference is that in wealth flip spreadsheet number 2, the Marcy family is going to perform the necessary steps to save that $700,000. But before we get there, let's scroll down to the results section of the personal tax planning template and just make sure we understand the amount of taxes and IRMAA that we are looking at in the base case. So right here, you can see for the base case, which is going to be the Darcy family, the family that is paying too much, they have an effective tax rate over the life of the example of 17.5%, and they have a grand total tax paid of $1.8 million and a grand total IRMAA surcharge paid of $91,000. Now, I'm going to lock the base case as we always do. And so when I go over to spreadsheet number 2 to look at the wealth flip, you will see these amounts right here will be fixed. That represents the Darcy family. And these amounts right here will also be fixed. Those are the numbers for the Darcy family. Okay, here we are in the Wealth Flip version of the personal tax planning template. This is where the Marcy family has undertaken several tax planning strategies to reduce their lifetime tax burden and their IRMAA surcharge burden significantly compared to the Darcy family. So what is the first thing that sticks out to you right here? And you should have guessed it, Roth IRA conversions. Now, for those folks who've been part of the program for a while, this is going to look like an enormous Roth conversion compared to the amounts that we typically see during our planning. And you would be 100% correct for noticing that. These conversions right here represent almost the entire pre-tax balance of both spouse 1 and spouse 2. Because remember, we started with $1.5 million as the balance at the end of 2025 for spouse 1, and we actually started with $1.2 million as the starting balance at the end of 2025 for spouse 2. So the only reason this is not a full conversion right here is because there was a little bit of return during this year right here. We can see the details of that over here on RCTS number 2. There's the $1.2 million starting point. We did go through 2 years of generating a 3% rate of return prior to the conversion. Therefore, after the conversion for spouse number 2, there is only $73,000 left in the pre-tax accounts. And all of this right here, except for the withholding on the conversion, has ended up over here in the Roth IRA. You can see there's the $1.2 million conversion. There is the $288,000 of incremental tax at a 24% marginal rate on that conversion. We are treating that as being paid 100% through withholding. So when we subtract the $288,000 of withholding from the amount of the conversion, the result is $912,000 going into the Roth for spouse 2. Same concept over here for spouse 1. We had the $1.5 million starting point. There's $45,000 of return at 3%, giving the account a value of $1,545,000 prior to the conversion. We did a $1.4 million conversion, leaving $145,000 in the pre-tax account. You can see same concept here. We are withholding at 24%, so $336,000 of withholding. That comes out of the $1.4 million conversion, leaving just over $1 million going into the Roth IRA. So now, coming back over here, this represents the concept of the Roth Conversion Wealth Flip. The Marcy family has flipped nearly their entire pool of wealth out of a pre-tax situation and into an after-tax situation, and each spouse did it in one fell swoop. The Marcy family isn't messing around with $10,000 here, $20,000 there, $25,000 another year. They did nearly the full account balance all at once. Now, what's another thing you notice right here that the Marcy family flipped? Well, what happened to the interest income? There was a row of interest income numbers right here in the Darcy family's calculation. In fact, if we hop back over here to the base case, there it is right there, starting with $45,000 and growing by 3% annually. What happened to all this interest income? Where did the Marcy family flip this to? And the answer is they flipped it over to municipal bonds. Municipal bonds generate interest income that is tax-free for federal purposes. Whether it's tax-free or not for state purposes will vary, but just considering the elephant in the room, federal income tax, this interest income row now goes to zero. That was a complete flip of their non-retirement investments that were generating interest income from underlying positions that generate taxable interest income to underlying positions that generate tax-free interest income. Another complete and dramatic shift in where this family's assets are located. with the tax implications of that decision being on full display right here. The concept of the wealth flip that is being demonstrated here is massive action. This family is taking massive action, changing the vehicle that houses their retirement assets completely, changing the underlying investment that generates interest income completely. So now, with the two major components of the wealth flip completed, let's scroll down to the results area of the personal tax planning template and see what happened. So starting right here, total tax paid over the planning period for the base case, as we saw for the Darcy family. These are the same numbers as before. And now right here, total tax over the planning case. This is after the wealth flip with both the Roth conversions and the changing the interest income from a taxable position to a non-taxable position for the Marcy family. The total tax has dropped from $1.8 million down to $1.2 million over the life of the example, and the total IRMAA surcharge has dropped from $91,000 down to $25,000 over the life of the example. That's a $66,000 decrease in IRMAA surcharge, a $641,000 decrease in income tax, for a grand total savings for the Marcy family of $707,000. Okay, now I know, looking right up here, I got a bunch of eagle eyes in the audience, and they're saying, now wait just a second here, Justin. How can the effective tax rate in the base case be lower than the effective tax rate in the planning case if the amount of income tax paid has gone down by over $600,000? I don't understand this mathematics right here. Well, that's a great question. Let's jump into it. Remember that the effective tax rate is a ratio. It's a ratio of the total tax paid in the situation divided by the total amount of AGI in the situation. So if we go right over here to this cell and do a side calculation, I am going to sum up all of the AGI that is included in the base case. Okay, that number, which is the entirety of this row right here, is $10.5 million. Now I'm going to go to this cell right here and do another side calc, adding up the total amount of tax paid in the base case. That number is 1.839, which is the number that we can see right here. So now if I go back up here and I divide the amount of tax in the base case by the amount of AGI in the base case, that is how we get our 17.5%. But now let's do the same thing with the planning case. I'm going to add up all the AGI. That comes to $6.6 million for the planning case. Now I'm going to add up all of the tax paid in the planning case. That number is $1.2 million right here, as we can see in this cell. So now if I just copy this calculation right here and paste it right there, we can see that I'm getting 17.9. And so that shows you that just relying on the effective tax rate percentage could be misleading, particularly if you are taking tax planning steps that affect the denominator or the amount of AGI in the calculation. So to summarize, while it's true that the effective tax rate in the planning case actually went up by 0.4%, who cares, really, because the amount of tax actually paid went down by over $600,000. And the difference between these two AGI numbers is what? Well, it's all of the things we took out of AGI. Number one being the interest income, and number two, all of the return on the retirement accounts, which is now occurring tax-free in the Roth over a period of more than 20 years from the age of 73 out to 94. All of that return is now excluded from AGI in the planning case, whereas it was included in AGI in the base case because it was being included in the distributions that were coming out of the pre-tax accounts in the form of RMDs. Okay, now as amazing as this level of tax savings is right here, let's scroll up and take a look at the tax brackets to see if this is actually the best strategy that this family could come up with. And as those of you familiar with the personal tax planning template can probably see right here, this strategy is not even the most optimal strategy that this family would be able to find. Why is that? Well, because we're filling up all of these brackets, 22 all the way up to 37. 37 is not full, but the rest of them are full. And yet we still have room in the 12% bracket out here in all of these years. This family would be able to find even more tax savings by actually optimizing their Roth conversion strategy instead of just doing the one-time wealth flip. If we spent time filling up each year's brackets and smoothing out the income across all open remaining years, we would be able to reduce the tax paid by getting it out of 37, getting it out of 35, and probably even getting it out of 32, and having it more evenly distributed across the 24% bracket or lower. The point of the wealth flip demonstration is not to suggest that the wealth flip is the best or most optimal strategy. The point is to present you with a dramatic example that can show you the power of the Roth conversion even in a situation where we have not actually optimized the results. We are simply slamming all the income into these 2 years and filling up the brackets higher than we've ever filled them up before on the channel. Never have we pushed income into the 37% bracket. And yet you can see that even with that blunt approach, the power of the Roth conversion can be dramatic, especially if you have significant value in pre-tax accounts and you have the opportunity to move that future potential AGI into lower years and get it taxed in lower brackets. Okay, now one more thing I want to check. Let's answer that original question that we asked. Can we be in that 12% marginal bracket and also have $250,000 of annual cash flow while doing it? Well, first off, on the tax bracket side, let's just go back to the personal tax planning template real quick. You can see right here that if I just look at this row and I look at all the years starting here and beyond, we are in fact in the 12% bracket going out all the way to the end. Actually, it looks like we did get bumped up just a little bit right here into the 22% bracket. I'm sure that could be fixed with some more optimization, but other than that minor discrepancy, you can see we are in that 12% bracket all the way out to 2052, the last year of this scenario. Now, on the cash flow side, let's hop over here to the RCTS tab. I did set up a little cash flow side calculator right here in this first row, everything that says all other. I have pulled in the AGI starting at age 73 and going out to age 94 for spouse 2. Just as a quick check, let's see where this number comes from, 139,216. We're going to go right here to the personal tax planning template, and we're going to go right here to 2030, the year that spouse 1 turns 73. Our goal was to have $250,000 of cash flow for all years between 73 and life expectancy. So there is our 139,216 of AGI. I have taken all the numbers off of this row between 73 and 94 for spouse 2. I have put all those numbers right here. Now, let's also forget this does not include the interest income, which would be cash flow, even though it's not taxable. We're talking about that municipal bond interest income. This also does not include the 15% of Social Security, which is cash inflow, but is not a taxable item. So those items would actually increase this more than it currently is stated, thus reducing the amount of distribution that we would have to take from the Roth IRAs. However, let's just go with what we have here, knowing that there is in fact additional cash flow that would be included in these items. So once we have these amounts, which include all other cash inflow items, I have then taken $50,000 out of the Roth IRA for every year from the year that spouse 2 turns 73, all the way through life expectancy for spouse 2, which is going to be 94 in this example. And then I have taken out of the Roth IRA for spouse 1 whatever amount was remaining that we needed to hit $250,000 of cash flow. You can see those amounts as listed right here come out of the Roth IRA in this distribution column. You can see on RCTS2 that the $50,000 that I selected to take out of the Roth IRA for spouse 2 is coming out of the distribution column here. And the key item that I wanted to note is that once we reach life expectancy, there still is balance in both the Roth IRAs for spouse 2 as well as spouse 1. So we have not depleted our accounts. We do have the $250,000 in annual cash flow, and we are at that 12% marginal rate, thus satisfying the original question asked. While at the same time, the Darcy family, while they may have the same amount of cash flow, they are going to have far less on an after-tax basis, because without the Roth conversion and taxable interest to tax-free interest wealth flip strategy that was implemented by the Marcy family, the other family, the Darcy family, will be stuck at that 24% marginal rate. By the way, now is a good time for us to refresh ourselves on the 2 fundamental questions of tax. So starting right here with number 1, is the item taxable or deductible at all? And then number 2, if the answer to number 1 is yes, then what is the timing with which the item is taxable or deductible? Those are the only 2 fundamental questions of tax. Every other tax question out there, and you're probably thinking, Justin, there are millions and millions of tax questions. How can you say there's only 2? Every other one of them is just a subset of the 2 questions above. Every single thing you could ever think to ask about tax at the highest level will be one of these 2 questions right here. So with that in mind, there are only 2 fundamental solutions in tax planning. Fundamental solution number 1 is to change the character of the income or deduction. And fundamental solution number 2 is to change the timing of the income or deduction. Every tax planning concept is fundamentally one of these 2 things right here, or possibly a combination of both. So as an individual who is trying to do tax planning, what tax planning options do you really have at the highest level? Well, the first one, as I said, are changes in the character of income or deduction. So, for example, changing the character of interest income from taxable interest to tax-free interest. That is something that we saw in today's demonstration. That is an example of tax planning by changing the character of income. Another example, which we did not see in today's demonstration, but which I've mentioned many times before, is moving from non-qualified dividends into qualified dividends. That is another example of changing the character of the income. Other common examples, HSAs and 529 plans. These are examples of changing the character of the income or the deduction to be tax-free, provided that the income is used for a specific purpose. And then finally, we all know about the Roth IRA. This is another example of changing the character of income such that income becomes tax-free. If the income is generated in this type of vehicle, then the character is such that the income is tax-free. So by putting it in this vehicle as opposed to a taxable vehicle, you are changing the character of the income. So that's what all of these items right here represent. Now, what about this over here? Putting money into a 401k or a traditional IRA or other pre-tax accounts, pre-tax deferrals. This is an example of a change in timing. You are deferring when the income is subject to tax. Same concept with a Roth conversion. This is a change in timing. This is where you take income that is currently deferred and you accelerate it into an earlier year to take advantage of lower tax brackets potentially, but still you're just shifting income from one year to another. That is a change in timing. Now, as far as common deductions which are available to individuals, of which there really are not many: mortgage interest, state and local taxes, charitable giving, and God forbid, medical expenses. Most of these items are what they are. There is not a lot of planning to do around them. The most common type of planning that would be related to these deductions might be bunching. Bunching is just where you try to put a lot of this stuff in a single year to the extent possible. Typically, that can be done most easily with charitable giving. But again, that just makes bunching a change in timing. You're just changing the timing with which you do the charitable giving, or you are using certain tools like the donor-advised fund, which effectively allows you to change the timing. But other than that, there's not that much planning that can be done with these items. The key is that it's just timing. Again, the only possible types of tax planning are changes in character or changes in timing. And then finally, right down here, you can pass. You can die without having any transactions. If you do, your assets will be stepped up to fair market value in the hands of your beneficiaries. This, by the way, does not apply to retirement accounts, only non-retirement assets. So this is not really applicable in the examples that we went over in today's video. But the point of me including it here is, again, this is a timing issue. If you just don't perform any transactions such that enough time passes, such that you pass away before completing any transactions, then you have created a timing tax planning strategy by allowing these assets to transfer to your beneficiaries and receive a step up. Okay, but wait just a minute. What about writing things off? People are always talking about writing it off. I want to write stuff off. Well, as an individual, the concept of writing things off doesn't really apply. Yes, you might be able to say that these are kind of like write-offs. You're writing off this stuff. But really, when we're talking about write-offs, we are talking about going into some kind of business or investment, generally rental property of some sort, any kind of operating business, or certain types of investments against which expenses can be written off. Now, if you're just in these things for non-tax reasons, that's one thing. But if you are looking at these kinds of opportunities up here specifically for tax planning purposes, it generally means that you are looking to generate upfront ordinary income losses, which will flow through to your individual return as deductions. Individual filers who want more deductions than are just listed right here, you have to kind of cross over the line and get into this type of stuff over here. This is where you generate deductions that may be able to be taken on your tax return. Now let's focus on this red sentence right here, the first word upfront. That would mean if you engage in any kind of rental activity or business activity or get into some kind of investment and you're doing it for tax planning purposes, chances are you are looking for upfront losses to flow through from these investments or businesses to your personal tax return. For those of you that have watched my brand new series on the working interest in oil and gas property, that is an example of going into business or making an investment in a business that can generate significant losses up front. And those losses can flow through to your personal tax return. So what is the word upfront referring to with respect to our two possible tax planning options? It's referring to timing. We want those upfront losses right now so that we can take deductions now and save on taxes now. Getting those losses upfront is the timing part of the tax planning. Okay, now what about this second part right here? Note I took out the word income because we did not need that right there. All we need to say is ordinary losses. What is this referring to right here, this word ordinary? Well, it's referring to the character of the loss. In other words, a loss could be ordinary income or loss. It could be capital loss. The reason that folks want ordinary losses is because they can offset all of these other kinds of income over here. If the losses that flow through are capital losses, then they can only offset capital income. If the losses that flow through are passive losses, then they can only offset passive income with some exceptions, but generally passive income is going to limit the amount of loss that you can take on your return. That's why when you start hearing about investments like this, where you are being told that the losses that will flow through to you up front are going to be ordinary losses, that is the sales pitch, quote unquote, that you are receiving. People want ordinary losses. And there are certainly situations where you can get ordinary losses depending on the facts and circumstances of the underlying business and investment in your hands. But for purposes of this video, there's simply two things I want to point out: that every single item here is either just about the character of the income or deduction, or it's about the timing of the income or deduction. That is what everything in tax planning is about, ultimately, either timing or character. Now, for many folks who don't want to tread over here in your retirement years and deal with rentals and businesses and certain kind of investments, which let's say are a little bit different than you are used to dealing with at your brokerage. And so for whatever the reason is, you don't want to deal with this side of the planning over here. You want to just stick to what's happening on this side here. And so looking only at the individual side of the picture, which again is this part up here on the left, what are the main things that you could be working on? Well, I'm willing to wager that most of you who are interested in the topic of Roth conversions and who are watching this video, you have already done this right here. In fact, you have probably spent decades doing this. What is this again? It is a timing strategy involving deferring income. But what have we learned in so many different Number Crunch Nerds YouTube and members area videos? We have learned extensively that tax deferral inside a retirement account only matters if you can ultimately get the money taxed at a lower rate than the rate at which you originally deferred the money. Otherwise, the deferral is irrelevant. Remember, the concepts of time value of money or opportunity cost, these do not apply to the vehicle choice. In other words, the choice between a pre-tax or an after-tax vehicle, a traditional or a Roth IRA. These concepts may apply when choosing the underlying investments within the vehicle, but they do not affect the vehicle choice itself. The vehicle choice itself is a tax rate play only. So let's think about this. If you've already done this right here, you've already done the deferral part, you have spent decades doing deferral, then guess what? You have engaged in half of a timing play. The deferral part alone is only half the play. If you don't get that money taxed at a lower rate than the rate at which you deferred it, then you have accomplished nothing over the last several decades. And if you happen to get it taxed at a higher rate than the rate at which you deferred it, well, then you just got completely screwed by that tax strategy because you only did half the strategy and you didn't finish it. And by the way, didn't your mother ever teach you to finish what you're doing? If you don't perform the proper analysis to see if you need to finish the game, then guess who is going to finish the game for you? That's right, my friends. While you're over here watching the birds, Uncle Sam will be taking your money on his timing. Uncle Sam will finish the timing play for you. Someone is going to finish it. Every single dollar in those pre-tax accounts is going to be subject to tax. Whether that's in your lifetime or the lifetime of your surviving spouse, or within 10 years after the passing of surviving spouse, when those pre-tax accounts are in the hands of your beneficiaries. Someone is going to finish that timing play. And if you allow Uncle Sam to finish it on his timing, it is highly likely that your family will be paying 5 to 6 figures too much in taxes over the course of your life. The only way you're going to beat Uncle Sam is to lay out your numbers and figure out how to beat him by finishing the game on your timing. That is what the personal tax planning template is all about. It's about making sure that you finish the timing play on your timing instead of Uncle Sam's. You started the play, you've been doing it for decades, but now it's up to you to finish it. My personal tax planning template program is easily the #1 individual income tax training program on the market in the United States today. The personal tax planning template gives you all of the tools and training that you need to beat Uncle Sam at his own game. But as I always say, you have to want to do it. If you don't want to do it, rest assured, Uncle Sam will do it for you. Join the personal tax planning template program today with lifetime access for a one-time access fee using the link in the description below this video on YouTube, and I look forward to seeing you inside the class.